With earnings well underway, what seems to be on most traders' minds are, will tech stocks continue to rebound? To, I wonder if FANG is going to do as well this quarter as they did last quarter. Maybe even will AI stocks continue to push the markets higher? What most people aren't talking about is a real strategy to trade earnings quarter after quarter. This week, I want to discuss what not to do during earnings season, how I trade each quarter, and what's on my watch list for this Q2. Hey guys, Tom here. When it comes to trading earnings, the majority of traders fall into what I like to call crowd psychology. This means most people tend to follow what the collective view of the crowd says, almost like a cult, instead of their own individual viewpoints. One such thing comes to mind is multi-level marketing, all right, like Amway. Now, I'm not condoning or condemning any of these companies. There are over 125 million people working for an MLM, so maybe you're one of them. I'm just saying getting past level one in this business for you and a friend is very difficult. Usually you're paying money in the beginning with products just to get started. And you don't really sell anything, but few at the top are the money makers in this type of business. Now, I know what you're probably thinking right now. What in the world has this got to do with trading? Well, I'm going to tell you. MLM, like buying options into earnings, is a low probability event. And like MLMs, very few people have rules around the crowd and consistent winners. All right, here's what I mean. Take a look at this chart of Goldman Sachs. Now, a typical trader looking at this last quarter might have seen a drop in bank stocks because of Silicon Valley, thinking that buying calls on Goldman Sachs just before earnings and exiting right before earnings or right after earnings may have made sense. So let's take a look. You can see the rebound. You can see right before earnings, which was in one day on this chart. Goldman, by the way, is a leading bank and investment company. Some say it's the strongest in the sector, yet it gave up 20% in price during the bank failures in March. A lot of buyers drove this back up in April, right before its announcement. The crowd was getting more bullish as we went into earnings. So, at the money calls, let me put up a chart for you. 4 days to expiration, they're priced around $6. That means you have the right to buy Goldman Sachs calls at $3.40 for the next 4 days, but you're going to pay $600 per contract for that right. I show here the entry debit, the maximum profit, which is unlimited until expiration, and of course the maximum risk, which is what you pay for a call option. All right, trading at 580 by 605, $6 would have been easily taken for this. Now, what the crowd's looking at when they see this is the unlimited profit they could obtain if the stock were to jump up into earnings. What they fail to see is that Goldman Sachs needs to go up by 6 points in just 4 days to break even. That's like trying to roll a 7 on craps when everyone who knows something about craps knows that there's a 1 in 6 chance of rolling a 7. Now, let's just see what happens 1 day later when the earnings are announced. Take a look at what looks like the same chart, but things have changed. Goldman Sachs has dropped 2%. And that $600 call that you bought, well, guess what? It's down by $507. That's nearly an 85% drop in the price of the call. So why did it drop? Well, simply put, because the unknown portion of earnings became known. And as the stock opened up, everyone knew what was likely to happen. Volatility on these options dropped. Now, the stock price dropped a little bit, but the volatility dropped considerably more. And that's what happened to the stock options price. Now, I'm sure some of you are thinking, well, wait a second. What if I had bought puts prior to earnings and sold them with that 2% drop? Well, take a look at this chart. This is the Goldman Sachs puts. The at-the-money puts, they were trading for $485 for a contract, which meant we needed to see the stock drop more than $4.85 after the report came out. What happened? Well, the stock did drop, but here's the problem. The put options, which were trading at $4.85 before the earnings came out, they actually went $4.70 by $5. So if you would have sold at them at $4.70, you still would have lost a little bit of money because you'd have been down about $12. That's mid-price, or 2.5%, looking at what happened the day after earnings. So what do I do? Well, I like to look for both patterns on price and option volatility before the earnings announcement comes up. And I also like to get out before the earnings too. So that means I need to be well ahead of everyone else. Take a look at this chart in Advanced Auto Parts. see those last 3 quarters, down in price and up in option premium. Down in price in the middle and up in option premium. That's the red line. Down in price once again and up in options premium once again. So the pattern that I'm seeing here, folks, is the price tends to go down a week to 10 days before earnings, and option premium typically goes up. Now, while we can never guarantee the future outcome of anything, I like where this pattern's going. So let's look at the put prices on AAP 7 days before the last earnings report and see where they went. So 7 days prior, you could have purchased a slightly out of the money, this is really near money option. The May 26, 119 puts were trading for $4.93. In fact, they actually went up and they closed a little bit higher on the very first day. Well, guess what? The trade just kept on going. And take a look here. A few days later, this put option was up 75%, where we actually published an exit. So pattern, repeat, pattern, repeat. And if you like the idea of trading like this on a basis of individuality and not the herd, guess what? Here's my top 5 picks to trade before the earnings announcements. So take a look at each of these. I'm going to say them in order. You've got Biomea Fusion. That is BMEA. All right. You've got Pilgrim's Pride, PPC, Amazon, AMZN, Digital Ocean Holdings, that's DOCN, and finally EXP World, which is EXPI. All right. You can see here that if I were to get into these anywhere from a week to 10 days prior to their earnings, I know when their earnings are coming out. That AMC means after market close. It shows me their next earnings date. These have had price patterns and volatility patterns of 100% going back. There's some other columns on here that if you're an option geek and you like option Greeks, you can pay attention to. The one on the far right is the most important to me. That's called average return on investment. In the past, these options have returned, and in case for BMEA, 443% return on average. You can see PPC is in there with a 260% average return. Amazon 242, DocuSign, Digital Ocean Holdings 205, and then EXP World at 177. So take a look at the charts on each of these stocks yourself and see if you can spot the pattern going back in time. Now, in summary, not all these are winners, okay? Like everything in the financial markets, nothing's 100%. And there are losses in trading, but like any strategy, I like to follow patterns. I like to find what works best in earnings. I like to be in and out before the announcement's even made, because it allows the price of volatility to be like the wind pushing along my back. All right. Let me know what your comments are about earnings, and I'll see you next week.